Welcome to Something Personal. I'm Amy Liberta, the editorial manager at Palisades Hudson Financial Group. Tax season is here, and you may be seeing some changes this year, or maybe you were expecting some changes that haven't materialized. A lot of this traces back to one major piece of legislation that Congress passed last summer. Today, a tax professional will break down what you need to know about the One Big Beautiful Bill Act for tax season and for year-round tax planning. Eric Meermann is a senior vice president here at Palisades Hudson, responsible for firm-wide professional development, as well as supervising the Stamford, Connecticut office where he's based. Eric also works directly with clients across the country, offering tax planning and preparation, along with many other services. Welcome back to the podcast, Eric. It's always great to have you on.
Thanks for having me. Glad to be back.
So we touched on the One Big Beautiful Bill Act, or what our colleague Paul Jacobs called the Triple B, in our premiere episode of the season. And you also wrote about it for our firm's Sentinel newsletter last year. When this episode airs, the law will have been in place for about 8 months, give or take, but it still feels like a lot of people are struggling to really get their arms around exactly what this bill entails. Now, a lot of it doesn't have to do with taxes at all, and we're going to leave that a little bit alone. But I read back in December that Senator Tommy Tuberville of Alabama said straight out, most people don't really understand what's in this law, which is a little wild at this point. So I just wanted to check in with you before we dove in. Why do you think there's been so much confusion around it?
Well, I think there's a bunch of reasons. One of which is I know you're a big news follower. Have you seen the news for the last 6 months?
Fair enough. Yeah.
This was big news for the couple weeks while, it passed and everyone was debating back and forth, the merits and the who's it going to benefit, who's it's going to hurt. But the news cycle moves very quick. And, in our bifurcated news media ecosystem that we live in, you're either on one side or the other, and you're generally stuck in that bubble. And so if you're on one side, you're hearing, oh, this is just a big give to the rich, and maybe there's some truth to that. If you're on the other side, this is going to skyrocket the economy into the future, and the America is going to be better than it ever was. And there could be some truth to that too. Mm-hmm. But once those political talking points go away and wars, natural disasters, crazy things being said by all kinds of different politicians, hint, hint, the news cycle moves so rapidly that this just got lost. This is like, 50, 60 news stories ago. And sure. That's, I think that's a major reason why it's sort of dropped off the radar for people. The other part is people don't even start thinking about taxes until February or really March, and hopefully not April, especially as a tax preparer. I hope people are not waiting till April to start thinking about this. But in our practice, we find that people really don't care or start thinking about taxation until they actually have to do their tax returns. So I think a lot of people are going to start thinking about this quite soon. We're taping here in early January, so by the time this airs, we'll be getting into a time when people really want to be focused on this type of stuff.
Yeah, July 4th when it passed, not traditionally a time I think about my tax returns, and I imagine that's true for a lot of people.
Yeah, totally.
So I think listeners who follow the news, if they can stretch back 50 stories ago to when this law was being debated, know that tips and overtime were two of the kind of big headline wish list items the administration had campaigned on, and that they really wanted to get into this bill. So maybe let's start there. I think many people heard that they made it into the One Big Beautiful Bill Act, but exactly how did they make it in? What are the details of the final version that made it into law?
Sure. Yeah, they did make it in different forms. There was a big political push, as we heard about from the Trump administration to cut tax on tips and overtime. We'll take them separately. Mm-hmm. For tips, taxpayers for the next 4 years, 25 to 28, you will be able to deduct up to $25,000 of tips from taxable income. So you have to think about, well, who gets tips? What is a tip? Mm-hmm. There was some debate as the bill was getting crafted as to whether, well, I'm a financial planner, and part of my compensation is a bonus. Could we call that a tip? Could Larry Elkin, my boss, give me a tip for all of the good financial planning, wealth management, and tax prep I did? Well, that's all been cleared up now. Mm-hmm. Treasury Department has issued a list of about 68 professions, and they're what you would expect, people who would traditionally get tips: waiters, bartenders, cab drivers, those types of occupations. So if you receive tips, you can deduct, as I said, up to $25,000, and that's 25,000 whether you're married or single. As we go through this podcast, I'm going to be talking mostly about the single numbers. And in most cases, the married number will just be double for married filing jointly filers.
Sure.
For married filing separately, it's often equal to the single. But for ease of listenership, I think we'll just stick to the single numbers. But I can highlight when something is unusual. And this one is a bit unusual in that it's 25,000 of tips per tax return. So if you have two waiters that are married, you can only get the one deduction.
Okay. And you mentioned 25 through 28. Is it correct that this is retroactive for last year?
Correct. Yeah. For 2025 through 2028. Now, again, taxes being such a political football, that can certainly change between now and then, although I don't think it will, but who's to say? But oftentimes Congress doesn't take up new tax legislation until the minute before or sometimes the minute after provisions expire. So until late 2028, 2029, we probably won't get much of a guidance on if this is going to stick around permanently or not.
Okay. So that's kind of the overview with tips. What about overtime? How's that the same and how's it different?
Yeah, overtime is similar. It's for a single person, at $12,500 of their overtime income can get excluded. Now, there's a limitation on this, which is taxpayers making over $150,000 phase out. And a phase out is where you don't just eliminate as soon as you go over $1 over 150,000, but rather it phases down percentage wise up to a certain number. And all of these phase outs are different. So if you're below 150, you can do the full 12,500. If you're above that, there's a somewhat complex calculation to figure out, how much of it is phased out.
Makes sense. So I know that tips are already broken out when you get your paperwork from your employer. How are you going to know how much overtime qualifies for this deduction?
Well, that's going to be really interesting to see, because this is, as a tax preparer, my first season going into preparation season post one big beautiful bill. So I haven't seen what it's going to look like yet. But the idea is puts a really huge record keeping requirement on payroll departments and managers to isolate exactly how much of the time on their employees' timesheets is attributable to standard salaried, typically 40 hours a week, and anything over that would be overtime. And it's going to break it out on the W-2. But Congress has said that employers can use any quote unquote reasonable method to approximate income for 2025. Since, we're halfway, we're already into tax season. You're just going to do the best you can.
They were halfway through when this bill passed. So it was like, surprise, it's July. Now you got to figure this out.
Another thing we should think about with both the tips and the overtime is that doesn't apply at the state level or the local level. If you live in New York City, those state taxes still apply.
As someone who pays New York City taxes, I can tell you they apply really hard sometimes. Other than the income phase out, are there any other restrictions on the kind of overtime that are available? I know we talked about with tips that only certain professions could get it. Were there any other restrictions in play with overtime?
Yes, actually, the deduction only applies to overtime required by the Fair Labor Standards Act. So this is not things that are stipulated by, say, union contracts, collective bargaining, state law. This is your traditional overtime where you get paid, time and a half.
Okay. So shifting gears a little bit, I want to talk about another part of this law that was in the news a lot, which is Social Security. I know people in my life have brought it up. I'm sure even more people have brought it up with you, considering what you do for a living. But it seems like there was some sometimes badly worded, sometimes some straight up misinformation floating around about how this law impacts Social Security taxation. So let's set the record straight. Does this law affect Social Security? It
certainly does affect Social Security indirectly, but let's just be clear. There is still tax on Social Security. We've often heard in the political sphere that, we're exempting to Social Security. No tax on Social Security. No tax on Social Security. No, that's not true. There is still tax on Social Security income. But what this new deduction for older adults does is it gives $6,000 per person over 65 added to their deductions. So for a married couple, it would be twice that. This is on top of the standard deduction that most taxpayers take. And it also stacks with the additional standard deduction that's already in the tax code for those over 65. So that's $2,000 for a single person. So it's sort of a stacking. You get the standard deduction, then you get $2,000 for being over 65 under the old law, and then you get this additional $6,000. So in practice, for people on a very fixed income that receive most of their income from Social Security, the way that calculation works is super complicated, but this will actually wipe out tax indirectly for people that are living solely off of Social Security. So it's true that it could make people in that situation pay no tax, but theoretically the tax is still applicable to Social Security income.
Sure. So other than your age, are there any requirements for this new deduction, any phase outs as we discussed with tips and overtime?
Yes, this deduction phases out at a 6% rate for individuals over $75,000.
And also not a phase out exactly, but I understand that seniors who are married but filing separately aren't eligible for this at all. Is that correct?
Correct. Yes.
Okay. And does it also have a built-in sunset date like the other provisions we've discussed?
It will sunset after 2028, just like the tips and the overtime.
Yeah. As we mentioned, unless Congress decides to do something about it, as they did with this one, as we'll talk about. And actually, as I'm about to dive into now, a lot of the things in this bill were responding to a law that was passed in 2017, the Tax Cuts and Job Act. So while we're here, looking backwards to 2017, I remember that at the time, our company in the newsletter discussed a lot about the SALT cap, or the state and local taxes. So how does the One Big Beautiful Bill Act change that rule? And can you just sort of touch on how it's going to affect people going forward?
Sure. Yeah, this is a big one for people that live like myself in New York or California, high income tax states where you pay a lot of state and local tax. So SALT is state and local tax. And people get confused about, well, what's the SALT? It's not just the property tax. A lot of people think property tax that they pay, which, you know, where I live in Westchester County, could well be over the former $10,000 a year cap. It's also the sum of that plus your other state taxes paid, most notably income tax. Mm-hmm. So under the pre-TCJA, you would have a situation where very wealthy people would be taking state income tax deduction for hundreds of thousands of dollars, although that would get cured by the AMT, which we might get into a little later.
Okay, so what's changing going forward?
So yeah, the big change is that it's going from 10,000 to 40,000. Mm-hmm. So that's a pretty big change for someone, you know, high income person or someone that lives in a very high property tax area or both. Mm-hmm. You know, you may be paying between state and property tax, you know, $100,000, you used to only get to deduct 10 of it. Now you get to deduct 40. So for instance, you know, it's a $30,000 difference. Say you were in the 32% tax bracket. Mm-hmm. That would be a $9,600 difference in tax paid.
Yeah. Are there any new restrictions on this change, or is it across the board?
Yes, there are. There's, as with so many other things, there's a phase out here as well. And mm-hmm. for modified adjusted gross income, once you get over $500,000, it starts to phase out up to $600,000.
So we have a phase out. Do we also have an expiration date for this one?
Yes, this one's the same as the others.
Okay. I promise the answer will eventually be different, which is why I keep asking it. But I just wanted to be clear.
Yeah, no, it's very important that people realize that some of the cool stuff, like I like the SALT cap living in Westchester County. I'm like super excited about this one.
Sure.
It's not forever, you know, and in prepping for this podcast, I reminded myself that and I was like, oh, bummer.
Yeah. Yeah. So while we're here talking about sunset dates, we wrote in the newsletter article last summer that a lot of provisions from the Tax Cuts and Jobs Act of 2017 were set to end at the end of 2025 of last year. So can you give listeners a quick rundown of some of the things that the One Big Beautiful Bill saved from going away?
Yeah, sure. You know, the Tax Cuts and Jobs Act from 2017, that was a huge bill as well. So we're not going to be able to go through all of the provisions. Sure. There was a lot, but some of the main ones are the income tax rates in the brackets. They're lower rates and lower brackets. So the old top rate was 39.6. The new top rate is 37%. And the other lower ones, they're all lower as well as the brackets are wider. and more inflated. So that benefits pretty much everybody. Just having bigger brackets and lower rates helps lower everyone's taxes. Also, the much larger standard deduction is roughly double what it used to be pre-2017. That's sticking around, and these are now permanent changes. So, as permanent as tax changes could be, the rates, the brackets, the standard deduction, the way all that works, that's sticking the same on a go-forward basis.
Yeah. So with permanent, basically what we mean is Congress has to proactively change them instead of Congress has to proactively save them from disappearing.
Yeah, that's right. I mean, I've been working here, almost 26 years, and the number of permanent tax changes, I can't even count how many permanent tax changes have changed in the course of my career. One of the other things that's staying pretty much the same is alternative minimum tax, or AMT, which I had referenced earlier. The AMT, it's like a parallel tax system that's running when you do a tax return. You have all the regular rules and regulations of taxes, and then there's almost like a parallel tax being computed next to it. And that is the alternative minimum tax. And what that does is, for people that used to take huge deductions for things like investment management expenses or unrestricted state and local tax, they would generally be very wealthy people, right? And so the alternative minimum tax was an attempt to add back in all of those deductions that very wealthy people take, so that they don't completely escape taxation. What the Tax Cuts and Jobs Act did, and the One Big Beautiful Bill has reinforced and made permanent, is a much larger exemption for AMT that makes the percentage of people, even the wealthy, that hit it much, much, much lower. And I've noticed this in our practice. AMT and teaching all our staff about it and trainings about AMT was a huge part of what we do here for our clients. After the Tax Cut and Jobs Act, it was rare to see our average client hit the AMT.
So we've got income tax brackets, we've got AMT rules. Anything else that is now preserved or made permanent that was originally in the TCJA?
Yeah, another interesting one was the mortgage interest deduction. So that went down from what was a larger number of 1 million. It's now $750,000 of mortgage debt principal that you can take the mortgage interest deduction on.
And I know we spent a lot of time talking about qualified business income, or QBI, back when the other law first passed back in 2017. I'm going to put a pin slightly in that we might circle back to it later in more detail. But my understanding is that is now also permanent. Is that true?
Yeah, that's right. The qualified business income deduction. What that is people that run self-employed businesses or operate in a pass-through entity, they can basically take a deduction for income that flows through from, say, partnerships or self-employed income on their Schedule C, which is usually, like a sole proprietor or a single member LLC. You get a deduction for 20% of that net income. That's a very broad simplification of what it is, and that sticks around.
Okay. And while we're here, we got to visit our friend, the estate and gift tax, which I know is a big part of our practice here at Palisades Hudson. What's the lay of the land post One Big Beautiful Bill Act there?
Yeah, so estate and gift tax has been a huge part of our practice over time, but it's actually becoming less and less important because the exemption is so huge. Right now, it's $15 million per person. So for a married couple, $30 million. You have to have significant wealth to be super concerned about that. Portability, which is the portability of that exemption. So for example, if your spouse dies, you can port the missing whatever they haven't used of their exemption. So say they have 5 million left, you can port that over to your 15 million, and now you have 20. That sticks around. So that makes able to shelter a lot more wealth from the estate tax. I'd actually encourage everyone to listen to Dave Walters, my colleague's episode of Something Personal, where he really digs into estate planning. Yeah,
I'll link that in the show notes if you're curious about how that tax works and some sort of the nuts and bolts a little bit. I think it's actually a really interesting episode, if I do say so myself. So while we're here, sort of speed running through a lot of these provisions, I thought let's take a stopover for some of the things that affect parents and families specifically. It seems like there were quite a few in this law. What's different to start us off about the child tax credit now?
Yeah, so it's pretty similar. It goes up to $2,200 per child from $2,000, and that's indexed for inflation. So as inflation goes up, that $2,200 when it hits the next 100 will go up. The other part of that is the extra $200 of it is non-refundable credit versus a refundable credit.
Okay. And I know the 2017 law made some changes to 529 savings plans, which are used to save for educational expenses. Have there been any further changes to that people should know about?
Yeah, a new development with the 529 is that you can, under the TCJA or Tax Cut and Jobs Act back in 2017, you could include up to $10,000 for elementary and secondary school tuition, high school. College 529 plans were always about that college, but now you can include so much more like elementary school, and they've also broadened again the type of educational supplies. There's a whole list you can look at online, and the limit has been expanded to $20,000 per year for the elementary and secondary schools.
So it sounds like it's just building on a lot more flexibility kind of across the board for those.
Right. There's even training for workforce, on the job training, continuing ed, that you could use a 529 for that too.
Nice. All right. Well, speaking of prior episodes of our podcast, as we were a moment ago, earlier this season, I was talking with our colleague Ben Sullivan in an episode about nonprofits, and he mentioned some of the many changes to tax treatment for charitable giving that the One Big Beautiful Bill Act put in place. So for people who either haven't heard that episode, which I will also link in case you're interested, or people who could just use a refresher, what are the changes coming to charitable donations on the tax front?
Yeah, the big one there is the what we call above the line deduction, available even if you don't itemize your deduction for contributions up to $1,000. Again, that's for a single, double for married filing joint. They have to be cash. They can't be, tangible items or furniture, shirts, or shares of stock or anything like that. They have to be cash gifts, and they must go directly to an eligible nonprofit. For example, contributions to private foundations, donor advised funds. It has to be cash to a charity, to put it simply. But it's an above the line deduction, which, for people that don't itemize, they take the standard deduction, especially if they were elderly. We were talking about that. The senior deduction before, you could stack another $1,000 on that in cash charity.
Yeah, and it sounds like since the standard deduction has gotten so much larger than it used to be, you're going to have a lot fewer people itemizing than you used to.
Yeah, that's absolutely right.
So while we're quickly running through a lot of the deductions, another one that was publicized a fair amount was a new deduction for auto loan interest. What's that involve, and how do people qualify for that one?
Yeah, so that's for 2025. You can take a deduction for up to $10,000 of car loan interest. But there's a few catches. The vehicle must be assembled in the United States. So, the old concept of Buy American revived here, but really hard to figure out because, Japanese car makers, Toyota, they have plants in the U.S. So the dealer will obviously love to promote this as they're selling their new car.
Sure.
And they're going to figure out a lot of this process for you, the same way that electric vehicle sellers and dealers were promoting the old electric vehicle credit, which expired in September of last year. Car dealers are going to figure out which products are assembled and qualify for that, and they'll probably have their financing arm be happy to give you a loan on which you can deduct the interest on. Okay. And again, here, there's a phase out. So once you're over $100,000 for a single person, you're going to reach the phase out, which, again, is a mathematical percentage computation.
Yeah, I think we say on this podcast all the time, there's no one size fits all answer for anything. But I feel like today we're really diving into there is no one size fits all for any of this stuff, depending on your circumstances.
Yeah, each one's different. And I'll add, this one is another one that expires. This is one of the 2028 group.
Gotcha. So, Eric, we've kind of done a speed run through a lot of the most commonly applicable stuff, and I appreciate you for coming with me on that walk. And I hope it was helpful for our listeners, but let's kind of zoom out for a little bit. You're a tax professional. As we're talking, you said it's early January. This is going to air during sort of the thick of spring tax season. Are you expecting any particular experience as you deal with the tax season with all these new rules in play? Or are there any particular changes that you're expecting to have to navigate that are going to be a little more challenging than others?
Yeah, I think it's going to be really interesting tax season. One of the big things that people probably haven't thought about is, especially, well, specifically for working people, you have a job, you get a W-2, you receive your weekly or biweekly paycheck, and it has withholding on it, right? And that withholding is remitted to the government on your behalf. And then what you're doing with your tax return is adding up all the items of income and deduction, computing a tax, and then comparing it to what you've paid in. So for a lot of working people, all they've paid in is just whatever their withholding was.
Sure.
A lot of this we've talked about is new deductions, new tax cuts, lower tax rates, bigger brackets. And so what that does is create a lower tax, but no one changed their withholding. So what a lot of people are expecting is that people are going to be pleasantly surprised in April when they get their refund that it's going to be a lot bigger than you thought. Like, for example, that person we were talking about before that was subject to the old SALT cap of $10,000, in that example, that refund is going to be almost $10,000. If you had your withholding set to be like, I owe a couple $100, all of a sudden you're getting a $10,000 refund. And what's interesting about that is it's an interest-free loan for the government when you get a big refund. I always tell clients that you certainly don't want to underpay your tax. Never do that.
Right.
But you don't want to overpay by a whole heck of a lot because you're giving a loan to the government, starting with your first paycheck in January, and you're not getting that refund until April of the following year. So, you're not getting paid any interest on that. You can take that and invest it in a money market fund that yields, 3%.
Yeah, I think it's emotionally really fun to get that big check, be like, time to do something fun. But actually what you're saying is it was your money in the first place. It's not like you're getting new money. It's money that you've lent the government without interest for forever many months.
Right. Like you see a lot of commercials on TV around tax season. Oh, you'll get your refund this much quicker with our software or our service provider, or we will give you an interest-free loan against your refund. That's preying on people's psychological idea that it's like a bonus, but it's not a bonus. It's something that they've created themselves by paying in too much withholding tax against their pay every year. So what I would encourage people to do now, some people like that. It's a personal choice. It's a forced savings for them. If their paycheck was what it was, some people live paycheck to paycheck. So it's going to be, if it's $100 more, $100 less, they're going to spend all of it no matter what.
Yeah.
And so this is a way for them to be forced to then get a big bonus that they might not otherwise get. But if you're not in that situation where if you're a net saver of your money and you're more concerned about maximizing your wealth, what you might want to do is readjust your withholding on Form W-4, which you provide to your employer, and reduce the amount that you're taking out every paycheck so that you're not creating this big refund in April.
And I imagine that surprise big refund this particular year may end up happening to freelancers too, if they were basing their estimates on a tax return they prepared before this law passed last summer.
Yeah, that's right. If they were paying in quarterly estimated payments where, we were talking about wage earners, they typically don't have to worry about, how much they're paying in because your employer's doing it for you. But self-employed individuals have to, write a check, or I'm dating myself, pay online through ACH debit, their taxes every quarter. And those people may have been basing their tax projections, or their preparers would have been basing their tax projections off of, some version of the prior year and not taking into account all the changes from the triple B.
Yeah. So is it similarly sort of, I hesitate to use the word chaotic because I know you and our coworkers are very regimented, but is there always a little extra pressure the tax season after one of these big omnibus bills passes? Or does this one have any particularly, specific features that make it more interesting or more stressful for you? Yeah,
certainly. The big stress is going to be, does our tax software appropriately account for all of these changes? We do our best to try to know all this stuff off the top of our heads, but I'll be honest, I'm looking up some of this stuff as we're talking about it because your tax preparer doesn't know every single number off the top of their head because they change every year. They're inflation adjusted. Some are phased out, some sunset. It's hard to remember everything. And, the truth of the tax industry is we're relying on that tax software pretty significantly to be able to compute a lot of the finer points of these phase outs, deductions, and how they interact with one another, on itemized deductions or limitations on deductions.
Yeah. So I know we've talked a lot about the specifics of different people's situations, landing them in different places with phase outs and a lot of the particulars of these changes. But other than looking at withholding, is there any sort of broad-based advice you'd have for people as they navigate not only this year's tax return, but their tax planning for the next few years ahead?
Yeah, I think it's important to stay in contact with your tax preparer throughout the year. You know, a lot of times people, you know, they get their tax return done. It's done. That's it. I don't think about it again. But as circumstances change, you want to keep your accountant or wealth manager, personal financial planner. You want to keep that dialogue going so that we can find planning opportunities that come up as life circumstances change.
So when someone is preparing to work with their tax preparer, especially in a year like this one where there was just a big law change, are there any particular things that they should do to help set tax professionals like you up for success and to really have the time to dive into this new information?
Yeah, absolutely. Tax data collection for tax preparers has become more and more difficult year by year. In the old days, people would get everything in the mail, right? And we used to joke, you know, you get everything in a shoebox, and they would just put all the pile of envelopes in the shoebox, and they'd mail it to us, and we'd open up all the envelopes and find the W-2s and the 1099s and the K-1s, and we'd have someone sort them and photocopy them. You know, that sounds super old school, but there was a great part of that in that shoebox was 99% of everything you would need to do a tax return.
Sure. And
it wasn't on the client so much to organize and collate that data. Now, some clients were very, very detail oriented people. Think your engineers. Those type of people will fill out our organizer in complete detail. They'll almost do the whole thing for you. Fantastic. Yeah. We love that. And then you have the shoebox people. In this day and age, everything comes via an email saying your 1099 from your mortgage interest is available. Your 1098 from your mortgage interest deduction is available. Your K1, you might not even think about it because you don't get it till September. And so we've tried to put together, you know, organizers, checklists, you know, repeated follow-ups. The best thing anyone can do is take an active participation in their tax preparation by knowing and organizing their financial life of what they have, what they did. Did you buy a car? You know, in previous years, that didn't matter. But now with the new auto deduction, if you're not subject to the limitation, you know, we're going to need that interest deduction. And I would like to, you know, find that out with all the data at the same time, not as I go to file the tax return. Oh, yeah, I heard about this auto thing. I bought a car, so I paid $5,000 in interest last year. You know, that would be super helpful.
Yeah, I mean, I can say as a person whose situation is nowhere near as complex as many of our clients are, but I often use the previous year to be like, okay, I need to remember this form, this form, this form. And when there's a big change like this, as you say, things that didn't matter may suddenly matter. Things that used to matter may not if you used to itemize and now you're taking the standard deduction. So I imagine that the change can sort of hit both sides, both the professional and the preparing before you get to your professional. So having a greater timeline seems like it'd be helpful on both ends to me.
Yeah, and doing all this stuff earlier, as I mentioned before, starting in February into early March would be great, not, you know, April 10th. This year is going to be a hard one. It's going to be a hard one for, you know, every citizen that pays taxes to compile all their data and understand it. And it's going to be harder for preparers because there's all these new rules that need to be incorporated into their returns.
Do you expect you're going to see more people extending their tax returns this year in order to have more time to sort of navigate all of this?
Maybe. Yeah, that's a good question because usually it's a known thing that we extend for. So there's, you know, I mentioned Schedule K1, you know, it's a technical thing, but if you're an investor in a partnership, not a, you know, mutual fund or a stock or something, but you have a private partnership, those issue what's called a Schedule K1 that reports the items of income and deduction to you. Those are due by September 15th for their extended deadline. And a lot of those types of private equity or hedge fund investments get extended and you don't get them until late August, early September. So those are like known issues. And we know, okay, we're not getting this Schedule K1 from such and such private equity fund until August. So we're going to have to make an estimate. This year, it could be interesting to see because there's more information to compile at the client level and more for us to synthesize at the preparer level. If we end up taking some of that and saying, you know what, we have a good estimate of what you owe because an extension, as a reminder, is an extension of time to file the tax return. It is not an extension of time to pay the tax. So you have to come up with a really good estimate of what you owe and probably be a little conservative, pay a little bit too much, not a bit, not way too much, about the interest-free loan thing, but pay a little bit over in case you forgot some income. But yeah, I think maybe you're right. We could end up seeing some more extensions just due to the collection, but we'd still have to have a really good idea of what that liability is by April 15th, no matter what.
Okay. So regular listeners know that I always like to end an episode by handing it back to my guests. So we've covered a lot of ground here today. The law itself is hundreds of pages, so there's a million things we didn't even touch on. But was there anything that you wanted to talk about that we haven't talked about today, or just any sort of closing thoughts about tax preparation this year that you'd like to leave our listeners with?
Yeah, I think we did a good comprehensive review, and I think our listeners will hear that this is all really complicated, and there's a lot to think about. There's a lot to do. So, some people can handle it on their own, especially have a situation. Some things are simpler. If you just have a W-2 job, you have the standard deduction. That's pretty easy. You don't need a lot of sophisticated help with that. But if you have a complicated situation, like you have private equity, hedge funds, you have maybe international investments, things where foreign tax paid, rental properties, you have stuff like that. There is a lot that needs to be known. And so I would recommend consulting a tax advisor like Palisades Hudson.
Thanks, Eric. I really appreciated you sitting down with me today and sort of untangling this hefty piece of legislation together, at least from a tax perspective. I hope our listeners found it illuminating, and it's always great to talk to you.
Yeah, great to be here. Thanks, Amy.
Something Personal is a production of Palisades Hudson Financial Group, a financial planning and investment firm headquartered in South Florida. Our other offices are in Atlanta, Austin, the Portland, Oregon metropolitan area, and the New York City metro area. Something Personal is hosted by me, Amy Liberta. Our producers are Ali Elkin and Joseph Rangeli. Joseph Rangeli is also our director, editor, and mixer. If you enjoyed this podcast, please take a moment to rate and review us wherever you're listening. It's a simple way to help new listeners find the show, and we really do appreciate it. Thank you.